Welcome back to the Economic Analyst channel. In this video, I'm going to give you an update on the current status of the economy, where we are in the United States, and where I think things are going to head out. So in a typical economic cycle, as the U.S. economy emerges from an economic recession, much like what we did during the COVID pandemic, the Federal Reserve will print money in forms of monetary stimulus, hand it to banks to create loans, and this has an effect of artificially lowering interest rates. The effect of all this money printing, along with growth, creates higher prices, which then forces the Fed to reverse its monetary policies, tighten the money supply, which increases the interest rates, but then this reverses all of the growth effects that they had caused by this artificial stimulus. The result is that the economy peaks and then it heads into a crash, as these investments that were formed during a low interest rate environment cannot handle the higher interest rate environment, and the economy crashes. Then we rinse, wash, and repeat. We are here right before the onset of the peak and the crash, and the reason why we know this is because we went through our lower interest rate era about 2 to 3 years ago. We've incurred our higher price era 1 to 2 years ago. We're currently going through a higher interest rate era now, and so the next stage is the peak and then the crash. So taking a look at real gross domestic product, this is the measure of how our economy is growing, controlled for prices. It is true that the gross domestic product has shown some surprising resiliency in the wake of the higher interest rate environment and is continuing to strengthen. There's many reasons for this, but the major reason has to do with the fact that there's a lot of foreign capital flows of investment inside of the U.S. stock market and the U.S. bond market, keeping the U.S. government bonds, especially on the longer term spectrum, depressed more than they should have in the wake of higher price inflation, which is keeping stocks elevated. However, when we take a look at an alternative measure of the U.S. economy, which is real gross domestic income, we're actually in a recession when we measure by incomes. So incomes, earnings, controlled for prices, is actually contracted, meaning that the nominal income growth is not keeping up with price inflation, even though spending has and is continuing to outpace price inflation. The reason why is because consumers and businesses are increasingly borrowing more and more money in order to fight these higher prices. So in order to keep up with their living standards, which in turn is bidding up the consumer prices, they've had to borrow huge amounts of money, way more than their income, to maintain the standards of living that they have, because the cost of living has gone up. The consequence is that the consumer price index started to increase rapidly in 2021 and 2022, thanks to federal monetary stimulus. And even though we're seeing a correction in consumer prices right now, much of that correction is artificial, and we may see somewhat of a bounce back in the coming months with this CPI. The reason why the CPI has corrected in large part has to do with the fact that one of the two components of what makes up the consumer price index, which is producer prices, has corrected largely after peaking drastically in the middle of 2022. The reason why producer prices have corrected so harshly and so strongly is because the United States, faced with rising oil prices and gas prices at the tank and energy cost, decided to unload millions and millions of barrels of their strategic petroleum oil reserve, plunging this oil reserve level back down to historical lows that we have not seen since the mid-1980s, and thus drive down those prices temporarily. But now that that program has stopped and ceased in large part, we might see a correction in gas and fuel prices. They may not reach the levels that they did earlier on because of higher interest rate and borrowing costs containing price inflation and spending and tightening money supplies, but we should see somewhat of a correction, and we may see consumer price inflation correct upward above 4% before year's end. In the meantime, the money supply grew rapidly thanks to the Federal Reserve's antics in July 2020 to January 2022, and then something happened. The money supply peaked and corrected downward somewhat, and I'll get into the reason why that happened a little bit later on in this presentation. However, the federal debt has increased drastically by $8 trillion in the last 3.5 years, and this will have systemic consequences on the U.S. economy and seal its fate for the coming economic crash. So the reason why the money supply peaked in 2022 was because of the increasing investment in overnight reverse repurchase agreements. What happened here is that investors, banks, and money market mutual funds in large part started to borrow or started to lend money temporarily to the Federal Reserve. So what they would do is temporarily buy or own total treasury securities that the Fed would sell onto the market, and then every few weeks or few months when the contract would expire, swap it back for their money. Then they would continuously do this over and over and over again, getting paid an interest rate by the Fed as a compensation. The reason why they chose to do this was because owning the securities outright would have given them a risk of actually losing value on those securities, because as interest rates goes up, the price of those government bonds go down. They would be forced to hold those securities to maturity and incur systemic losses. So they bypassed this by temporarily owning securities, getting paid an interest rate by the Fed that compensated them, then trading those securities back at the Fed. The result is that the money supply started to actually contract in 2022 and 2023 as money that was given to banks originally started to end back up at the Fed. With the winding down of this program here, the demand for these securities has dropped thanks to the ever-increasing debt loads and the draining reserves at the banks. Eventually, this will cause the money supply to start increasing again, and if so, that will keep price inflation higher for longer than what was originally expected. While the unemployment rate has dropped drastically from where it peaked to record levels in the onset of the worst pandemic that the world has seen in about 100 years, real incomes have not kept up with real wage growth when we adjust for prices. So when we take a look at the adjustment growth rate of real earnings, we're seeing where earnings are now. There's about a 10% real wage gap. And so this kind of explains why there is a dichotomy between gross domestic product and gross domestic income. Incomes are just not keeping up with the high rampant consumer prices, so consumers and businesses are having to paper over that loss of standards by borrowing money, more and more money, which then still fuels consumer price inflation. So it's a vicious circle that we go in right now. This real wage gap may also explain why we're seeing from the top down from officials in Washington that the economy is actually doing really good because they cite the low unemployment statistic. However, among Main Street America outside of Wall Street, the economy is not doing so good. Why? Because real living standards have actually dropped. As a consequence, in addition to this, although the unemployment rate has lowered, the gap between where we were before the pandemic in terms of employees and employment growth and where our employment status now has still shown a split and a divergence between the two statistics. There's about 4 million less workers now working in the economy than what should have been. And the reason why is because the United States government, after the COVID pandemic broke out, decided to increasingly spend more and more money on social benefits, to welfare, Medicaid, Medicare, Social Security. You had a lot of people retire. A lot of people decided not to work at all, instead take government benefits, then decided not to go back to work. This has caused a split in the workforce, and this divergence can be explained by this gap of $500 billion on an annualized basis paid more out to people from the federal government. This also is inflationary because now these people are having purchasing power to spend on goods and services, but they're no longer working to replace what they are consuming, leaving less available for everybody else, driving up these prices for longer. In the meantime, the ultimate predictor of economic recessions for the past 40 or 50 years has been the yield curve, and the yield curve is once again negative. The yield curve, measuring it by the strict measure that I use, which is the federal funds rate, and comparing that to the 30-year Treasury rate, has been negative for about 8 months. It started at the beginning of 2023, and eventually I believe that this will become another perfect predictor of an economic recession and a crash. If you've listened to my previous videos, I think that this crash will materialize in 2024, though that's not necessarily a given because the confirming statistic to the yield curve is rising delinquencies and defaults on loans that usually occur before the onset of an economic recession. This was especially true in the last 3 economic recessions, and although we are beginning to see a little bit of a rise in these loan delinquencies and defaults, they haven't reached levels yet that I believe is confirming that the economic crash is on its way, though this could happen in the coming quarters, especially in the early parts of 2024. Another problem that we're having is that thanks to all the increases in government spending, although nominal tax revenues have increased, they have not increased to compensate for the increased government spending. And as a consequence, the deficit now, the federal deficit, is actually higher than what it was pre-COVID, which was already at record levels. So pre-COVID, the federal deficit was just over $1 trillion. It is now over $1.5 trillion at $1.7 trillion. And this will have consequences for the U.S. economy because the interest rates, the interest paid on that debt is starting to rise at a very astronomical and alarming rate. The interest paid on our federal debt has increased by $500 billion in the last 3 years. This is effectively a 3% interest rate payment that the federal government is making on its debt because the total aggregate debt right now has reached $33 trillion. And as this debt starts to mature, those interest payments will go up. Part of the reason why the interest rate payments are going up is also because the Federal Reserve has been unloading more and more government bonds back onto the market. So after the pandemic, they purchased $5 trillion of government bonds. They have since sold nearly $1 trillion of those government bonds that they purchased back onto the market. That increases the supply of bonds. When you have an increase the supply of a good or service, the price goes down. The price of the bonds goes down. It has to be compensated with a higher interest rate. The average interest rate of all total U.S. debt right now is about 5% on the market. So before, the federal government was paying an effective rate of 3%. If the effective rate starts to climb even further, and I believe that it will, and reaches around this 5%, that would mean that the U.S. government will be paying over $1.5 trillion, possibly close to $2 trillion on their debt as it starts to mature in the coming years. And that will increase the deficit even further, which will then put more rising pressure on interest rates. As a consequence to all of this higher interest rate environment that we were going in, the stock market has corrected after reaching its peak toward the end of 2021. As interest rates plummeted during the pandemic, the stock market went on a huge bull market swing upward as stock valuations increased within the wake of lower interest rates. But now these interest rates are going up. We're seeing this correction in the stock market, and although foreign capital flows are keeping the stock market elevated and the interest rates from climbing even farther, this is only a temporary stopgap. And if those foreign capital flows reverse, we could see a drastic drop in the stock market very quickly and systemically higher interest rates to go along with it. The current stock market valuation now, even though it has corrected from its peaks at the end of 2021, is still nearly 2 times or over 2 times what its real value is as measured by the gross private product. The gross private product is the gross domestic product minus out the government consumption and investment, since the government is not really adding to the aggregate private economy. And since the stock market measures private economy incomes, earnings, and revenues, it's a better way of gauging the health of the stock market in relation to the aggregate economy. Up until the mid-1990s, the gross private product tracked very well with the stock market. So stock market capitalization roughly equaled 1 year's gross private product. But then starting in the mid-90s and the 2000s, we started seeing bubbles develop in the stock market. And every time we saw a crash in these bubbles, they corrected down roughly to this gross private product level. I have reason to believe that if the stock market crashes again, it will crash by 50% from its current levels down to around this gross private product level. And right now, these stock market valuations from the treasuries are still suggesting that the stock market should be lower than what it is right now, yet stock market valuations are sustaining itself systemically higher than even what interest rates should say. But the lower interest rate environment accumulated over the last 15 years by the Federal Reserve has caused this huge historic bull market in the stock market, but I have reason to believe that it is a fake market. It is a false boom. It is a malinvestment of the proportions that we have not seen since the late 1920s, and the crash that will come may result in the same type of disaster that we had during the Great Depression. If you were to think that gold and precious metals are going to save you from this crash, it won't right away. And the reason why is because the rising stock market valuations above the interest rate environment, as well as a strong U.S. dollar, has kept these gold prices in check, despite the fact that we've incurred rampant consumer price inflation. Earlier on in the pandemic, we saw the potential here in gold valuations due to a correction in the U.S. dollar for gold to break out well above $2,000 an ounce and possibly even break up over $2,500 an ounce. Yet the dollar started to rally due to foreign capital flows coming back into the U.S. economy, where investors all over the world foolishly bought government bonds and invested in U.S. stocks. This created the huge stock bubble that we saw post-pandemic, which was already a catalyst from an earlier stock bubble before the pandemic. But as a consequence, gold prices will stay depressed until the crash sets in. Now, once the crash sets in and the stock market starts to correct, we will see these gold valuations start to escalate sharply. And as we know from history's times past, the Federal Reserve will be forced to reverse its monetary policy, foolishly thinking that the price inflation problems are over. They will print money, which will justify that higher gold price, and we will see that bull market resume in gold in 2025 and 2026. That's the current status right now of the U.S. economy. It does not look good, even though right now on the surface things appear relatively calm. They really are not. Thank you guys for watching this video. I hope that you learned something from this. If you like this video and the content that I provide, please make sure to like, subscribe to the channel, and click that notification bell so that you're notified every time I provide an update to you. Once again, this is The Economic Analyst, and I'm signing out.